Topic examines the different types of liquidity and the concept of contingent liquidity within financial institutions and markets. Liquidity generally refers to the ability to meet financial obligations when due without causing significant losses or operational disruption. The topic distinguishes among several forms of liquidity, including funding liquidity, market liquidity, central bank liquidity, and contingent liquidity. Funding liquidity relates to obtaining cash to satisfy obligations, while market liquidity concerns the ability to trade assets quickly at stable prices. Contingent liquidity refers to potential liquidity needs arising from unexpected events such as credit line drawdowns, collateral calls, or sudden market stress. Understanding these distinctions is essential for effective liquidity risk management and financial stability. A key focus of the topic is contingent liquidity risk, which arises from off-balance sheet commitments and uncertain future funding demands. Financial institutions often provide committed credit facilities, guarantees, derivative contracts, and settlement services that can create sudden liquidity pressures during periods of stress. Under normal conditions, these obligations may appear manageable, but adverse market events can trigger simultaneous demands for funding across multiple counterparties. The topic explains that contingent liquidity risks are difficult to predict because they depend heavily on market confidence, customer behavior, and systemic conditions. Institutions therefore conduct scenario analysis and stress testing to estimate potential contingent cash outflows and ensure sufficient liquidity resources are available during crises. The topic further explains that liquidity risks are highly interconnected across funding markets, asset markets, and institutional operations. Market liquidity deterioration can reduce asset sale capacity, while funding shortages may force institutions to liquidate assets rapidly, intensifying market stress. Contingent liquidity demands often emerge during these disruptions because declining asset prices trigger margin calls, collateral requirements, and contractual funding obligations. Financial institutions must therefore maintain diversified funding structures, high-quality liquid assets, and robust contingency funding plans. The topic emphasizes that liquidity management requires a forward-looking perspective because historical liquidity conditions may not accurately reflect the severity of future market disruptions or systemic crises. Topic also focuses on liquidity stress test design issues, which are central to evaluating an institution's ability to survive severe but plausible liquidity disruptions. Liquidity stress tests simulate adverse conditions such as deposit withdrawals, funding market closures, credit downgrades, collateral calls, or market-wide financial instability. The objective is to assess whether institutions possess adequate liquidity resources to continue operations under stressed scenarios. Effective stress testing helps identify vulnerabilities in funding structures, asset liquidity, and contingent obligations before actual crises occur. The topic highlights that stress testing frameworks should incorporate both institution-specific and system-wide scenarios because liquidity crises frequently involve broader market contagion and interconnected financial disruptions. A major challenge in liquidity stress testing involves selecting realistic assumptions, time horizons, and behavioral responses under stress conditions. Institutions must estimate how customers, counterparties, and financial markets are likely to react during periods of uncertainty. Assumptions regarding deposit stability, collateral availability, asset liquidation capacity, and funding access significantly influence stress testing outcomes. The topic explains that severe market stress may cause liquidity conditions to deteriorate much faster than historical experience suggests. Institutions therefore use multiple stress scenarios with varying degrees of severity to evaluate resilience comprehensively. Stress tests also examine intraday liquidity pressures, cross-currency funding risks, and operational disruptions that could amplify liquidity shortages during crisis periods. The topic concludes by emphasizing the importance of integrating liquidity stress testing into broader risk governance and contingency planning frameworks. Stress testing results should guide decisions regarding liquidity buffers, funding diversification, collateral management, and emergency response strategies. Senior management and regulators rely on stress test analyses to evaluate institutional preparedness and identify areas requiring corrective action. Regulatory frameworks such as Basel III reinforce the use of liquidity stress testing as a critical component of prudent risk management and financial supervision. Ultimately, effective liquidity stress testing strengthens institutional resilience by encouraging proactive planning, improving transparency, and ensuring financial institutions can withstand severe liquidity disruptions without threatening broader financial system stability.